Welcome back to the Algorithmic Advantage, everyone. The podcast today was very interesting. We were very privileged to chat with Perry Kaufman, weren't we, Rich?
Oh, it was fantastic. Getting someone with his level of experience on our show, it was a wonderful episode. So really appreciated his participation in it.
Yeah, it was really good. In fact, I want to start with saying just a lovely guy. He's just such a good guy, Perry. And we were very privileged to have someone with that much experience behind him, a lot of practical, a lot of theoretical experience. We know that he has been trading the same models that he's trading now for the last 15 years successfully. So that speaks volumes, obviously, and there's definitely something that you want to learn from a guy like that. Obviously, his primary book is Trading Systems and Methods, now in its sixth edition.
Sixth edition. Magnificent resource. Every trader and investor should have that on their bookshelf because it's a compendium of all you need to know at the system level, the portfolio level, and also a lot of the grounding theory that you need to understand about noise and signals. And more efficient markets are the more mature markets. The less efficient are the more immature markets. The trending opportunities in the immature markets. It's a wonderful resource.
Obviously, in that book, you'll find his introduction to the Kaufman efficiency ratio, a little indicator that he invented and brought to the industry. I found it really unique that he is obviously a futures and stock trader. So by combining both those worlds, I really think it's incredibly interesting how he has been able to learn from one and apply what he has learnt to the other. And a lot of people are not sure if they're, say, futures traders, some of the challenges of trading stocks and vice versa. So because he has done both, he really does bring some interesting insights.
Certainly does. But imagine having someone like Perry, when you're 20 years old, going into these markets, if you'd listened to the advice of Perry, you'd tested it so you're totally comfortable with it, and you've begun your journey at 20 years old with the knowledge that Perry's got now, life would be a totally different story to the trials and tribulations that 95% of us go through by going down the wrong path, thinking we know all, not sort of relying on the wisdom and experience of, the giants in the industry. And this is where standing on the shoulders of giants is one of the key ways to shortcut your journey to at least develop sound principles early on. And someone like Perry is an amazing like that, but it's taken him a lifetime to get to where he is now. And unfortunately, that's the way trading goes. If you try and do this yourself, it's going to take you a lifetime to reach your ambitions. And that's exactly when you don't want this to occur, because you want compounding to kick in when you're 20. And the only way to do that is to fast track the process by listening to the experts and standing on the shoulders of these giants.
And not assuming that you're going to just come out doing it so much better, as I did think when I was younger. Yep, and just a lot of time wasted in not just taking what they say as it stands, implementing it as it is, learning from that, and growing from there, because then you start the compounding process as well, as opposed to starting the drawdown process and the account blow-up process and all of that. One of the things that really stands out for me in that, of course, and it's something similar to what you do, Rich, in his selection process, where he really values the testing of how his systems have performed over time on every different instrument, and he uses the performance of his system as the indicator more so than the performance of the underlying stock or contract.
That is such an important principle, Simon. And the ability of us to generate profits is dependent on two things. It's dependent on the market condition and most importantly, is dependent on the system that's used to extract that opportunity from the market. Therefore, it must be an assessment of your system performance. That is how you analyze these markets. Don't just think in terms of what the markets themselves are doing. Importantly, what are the outcomes, the trade outcomes from your system being applied to that market? When you use that information, that's important for correlations and all of these things we talk about, but it's a trade performance that, to me, holds primacy as the key in any form of analysis about what's going to be successful in the long run.
Yeah. Well, the show is jam-packed full of goodies. Of course, we talk a bit about the volatility adjustment process. He has a different take to yourself in terms of using a narrower selected universe of stocks and how he ranks in the way we just discussed to determine which stocks and systems are running at any particular time, or futures contracts. So it really is very interesting to hear that perspective, and of course it opens up trading possibilities for smaller account sizes as well.
Exactly.
So,
and look, one thing I'd just like to say is that when you enter the stock universe, it's a bit different to how I've entered the futures or the CFD universe, in that in the stock universe, you're dealing with the possibility of a universe, 3,000, 4,000, 5,000 different stocks, and they're all unlevered, unless you manage to get some leverage into it. But the majority, they're unlevered, which means that with finite capital, you must apply some form of ranking system to select from that huge possible universe. This is different to, say, my futures or CFD universe, where we're trading with highly leveraged instruments, maybe micro lots or mini lots, which allows us to trade a very wide, diverse market universe and not have the complications arising with limited capital that's faced in a stock universe. So I can see why Perry's approach has been shaped with his selection and ranking process. Look, there was one part, though, Simon, I just want to bring up. In their podcast, Perry suggested that he heard from me that when you increase your levels of diversification of a market, say in the stock universe, ultimately that just means that you're going to be benchmarking yourself with the S&P 500. In other words, as you progressively increase your diversification, let's say to 500 stocks, etc., that's when your performance is in line with the S&P 500 and it doesn't exceed that. Now, I'd say, well, actually, no, I disagree with that, because when we're applying trend-following models to the equity markets, they're not active all the time. So if, for instance, I diversified with a buy and hold strategy across 500 markets that were in the market all the time, yes, it would approximate the performance of the S&P 500 by virtue of increased diversification. But because I'm very selective of when I enter material trends, my systems are inactive until those material trends arise, then they become active, and they're also long and short. That means that under this massive diversification, it actually doesn't approximate the S&P 500. It actually exceeds the performance significantly of the S&P 500, because it's not trading a lot of the noise or the minutiae, which, 460 or 80 stocks of the 500 are sort of not offering significant opportunities, and maybe only the FANG stocks or the top 10 or whatever are operating the driving performance. So I just wanted to say I don't quite see it the same way as Perry there, but I just wanted to raise that.
No problem. All right, well, let's just let the listeners get on with the show, and here's the show with Perry. Enjoy.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
Well, Perry, we've just been recording, but I didn't press the record button. I have now, so we're going to have to start again, and I'm going to say welcome to the show once again.
Yes. Okay. Well, thank you. I'm glad to be here. I'm glad to be recording.
Indeed.
Great to have you here, Perry.
Thank you, Richard.
Yeah, it's great. So, Rich, we were talking about his books, weren't we? I mentioned that I had one of his earlier books, not, of course, his first, but this is from 95, slightly before I started, but when I was at the Sydney Futures Exchange, I picked that up. And Rich, of course, you were talking about how inspirational Perry's books have been for you through the course of your journey.
They certainly have, Simon. In particular, his trading systems and methods. So, Perry, so for our listeners, Trading Systems and Methods is now up to its 6th edition, and each edition has been is different based on new research that Perry has slowly integrated into the process, and he's been writing it over decades. We're up to the 6th edition. So just so if everyone is unfamiliar about Trading Systems and Methods, it probably is one of the most significant go-to books for the trading and investment community, particularly those involved in systematic trading. Every stone is turned by Perry, looking at a variety of different techniques and methods, looking at the mathematical basis of it all and its efficiency and effectiveness, and it truly is an amazing resource. And in the early sections of the book, before you start getting into the systems and methods themselves and then the portfolio management, in the early sections, Perry talks about how the nature of markets has become more efficient over time. And for those that are aware, Perry has got his own indicator called the Kaufman efficiency ratio, which looks at the degree of signal and the degree of noise in markets. And it's quite conclusive in that in the nascent infant markets, there is a much higher trending signal than in more mature developed markets, probably attributable to the increased participation by different players and their models, in that as you get more and more different participants with different models interacting in the market, it creates much more noise. But the trend is still there, but to capture that trend, you need to step out to the medium to long term to now find it. And we were talking about how in the early 80s and 90s, a lot of the well-known traders like the turtle traders, Dunn Capital, etc., found that their success was driven more in the short to the medium term in capturing trends. But as the markets have matured, more participants, HFT, all of these different influences have come into the market. They now have to stretch out to the medium to long term. And I just want to now pass it to Perry to explain his good insight into the nature of the equity indices, such as the S&P, being both trend in nature and mean reverting in nature. So, Perry, can you explain that?
Yes. We were saying that the best calculation period for the S&P is now up around 100 days. If you're looking at moving averages, or 110 days. I have to point out, when we go out to that longer period, it also increases the risk. And so, when you're holding a trade for 110 days, you can't get out if the market drops 10%. You may still be in a long trade. So, a better strategy these days has to include a lot of risk analysis, which it didn't have to do back when a 10-day moving average worked.
Yeah.
But let me also emphasize what you said about new markets. New markets are very interesting because they have low volume, so you can't trade in big numbers. But the way a new market starts is you get a lot of commercial traders on board that are going to make liquidity. And they tend to have the same attitude towards whether the market's going to go up or down. And so those those participants will create very nice long trends early on. And then as those trends get recognized, you get more and more people jumping in. And those people, it seems almost counterintuitive, but those people cause noise. They enter at different times, they take money out at different times, and they cause the market to jump up and down. And as that participation increases, as you said, we have to expand out our time horizon. And of course, by doing that, you make money. You don't make quite as much as you used to, and the risk is higher. So you have to spend more time trying to figure out how to control your risk as part of your program, which we didn't have to do much earlier. So,
Perry, can I ask you a question here? And it's a question that's befuddled me for a long period of time. And let's assume...
Nothing's befuddled you.
Let's assume that we've got the participants in the market initially, let's say, being trend traders. They've all got the same general view of where prices are going to go. And let's say they're applying a trend following model to that market. So with the significant, mix of participants being trend followers, their signals augment each other. They don't destructively interfere with each other. They amplify the trend signal.
Yes, they piggyback off one another.
And so if their expectations are they see the price moving up, they're jumping on board that moving up, so they're amplifying that price move up all the time, where we get this magnificent extension of material trends with little noise. But the question I've got to ask on that principle, and that's a logical positive feedback mechanism, which is different to mean reversion, which is what I call a negative feedback mechanism. In other words, if you are waiting for a price excursion away from an equilibrium, and then you are with the expectation of reverting to the mean, and when you go through that equilibrium, reverting back up to the mean in an oscillating manner, that is a destructive signal, which means that as more and more participants do mean reversion, the signal gets destructively interfered with. So this is how I'm seeing the mechanics play out, sort of almost like in a physics lab where I've got a wave tank with waves interfering and cancelling each other out, etc. But when I hear people talk about trend following, some of them say, oh, there's so many participants who are trend following, they're eating the edge away from trend in the market. I don't necessarily agree with that based on the principles I've just talked about. What do you think about that?
Well, we were talking about the fact that the trends, a successful moving average in a noisy market has to have a longer time period. And not only does it have a long time period, but I think when you extract what you can profit from, you're getting a smaller payout. So when there's more and more noise in the market, it takes you longer to identify when the trend has turned.
Yeah.
And that increase in the time it takes you to recognize it cuts into your profits. So you get both a longer period and a shorter profit, which is unfortunately, and that's why people come up with different strategies to try to capitalize on different aspects of the price move, because the long-term trend may be a good underlying strategy, but it's no longer producing the big profits.
So it's a very weak edge these days. It was a stronger edge in the past, you're effectively saying.
Yes, it is. And while you can point to particular markets, as you know, the cocoa market, there's a certain market you can actually capture a large amount of profit, but it's a small number given the markets that you're trading. So, if there are 65 or 70 good futures markets with good liquidity, a big move in cocoa is going to be great. but how much is it going to participate in the overall profit compared to the markets that are not doing much? So there's an interesting here, and we'll come back to it later. The idea is whether you should be diversifying into a large number of markets or trying to select which markets are most likely to participate. Because if you can pick a small number of markets that have a high likelihood of good returns, you're going to get a much bigger payout than if you diversify into 50 markets. With 50 markets, you will reduce the risk because of diversification, but at the same time, you're going to reduce the returns. So that's your big trade-off. Do you want to trade a smaller number of markets and look for a bigger payout with also bigger risk? Or do you want the more conservative, highly diversified portfolio with less risk? And I think every trader has to make that decision. So I'm a fan of smaller with more risk.
Okay. Looking forward to this discussion.
Yes, it shouldn't happen. As we get older, we're supposed to take less risk. But, I've done this for a long time. I like risk.
Well, Perry, just while we're on this topic of how the markets have changed over time, perhaps increased participation, more noise, and trading gets more difficult. I guess two things come to mind. One is that there are some positives in the sense of commissions have become a lot lower, slippage might be less. The tools that the average retail trader has are quite phenomenal now, so the retail trader is able to compete at a much higher level. But then on the flip side, of course, the increase of technology and including AI now makes one wonder whether it is just a race to the bottom. Like, do you foresee any threat there from the AI and the tech and the increased participation, whether really the markets do become so efficient that it's impossible to extract alpha?
Oh, the markets will never be efficient. So,
while people are involved.
Yes, there's always an opportunity to make money. If the big funds are going out with long-term trends, then we were talking about the S&P is both mean reverting and trending. In the very short term, it's mean reverting. You can trade that. And in the long term, it's trending. But it's not as good as interest rates or the FX market, which is likely to produce much more profits than the S&P. But going back, I hate to be intellectual about this, but if we look at the way I've seen AI, it's wonderful in what I call a closed system. AI can, if you give it a bunch of rules and you give it a set of data, and you say, there's never going to be more data than what you see now, you have a closed system. It can find a perfect solution. But the stock market's not a closed system. It keeps making new highs. It keeps getting more volatile. It keeps changing. And I haven't seen any AI solutions that go out of the box, that are able to give you a forecast that it hasn't already seen before.
It's interesting you say that, Perry, because I'd probably raise the same argument about people. If they're put into an environment that they've had no experience or learning from, they're probably going to suffer the same consequences as AI. So there isn't any leap forward ability in this open system to be able to predict the future. So we're pretty well safe there, perhaps.
Yes. Now I have no idea where AI is going to go. I'm sure after I'm dead, it'll be much more sophisticated. But right now, I don't see any danger to our trading from AI. So
that's good.
Yes.
Okay, Perry. That's a great introduction and background. Let's sort of move the discussion into your strategies and talk about talk about your models and your philosophy, and ultimately your portfolio construction and risk management techniques, and all of the wisdom that you've gained over the years. I know that you've told us before that you're trading effectively the same strategies for the last 15 years and have beaten the S&P each one of those years. So anyone who has been applying those same models for that amount of time, it obviously speaks volumes for those models. So we know that you started, I believe with options, but really started with futures and then decided to apply those same futures models to equities, and we're able to do that quite successfully. So can you tell us about your models and how you are able to apply them to both futures and equities?
Yeah. Well, first, I did trade futures from 1970 to 2005. So I have a good background in futures. But about 2005, somebody asked me to look at the stock market. And of course, the big difference between futures and stocks is that you can't trade all the stocks. I mean, if you have a big fund, you can trade most all futures or a good sampling of futures. But, if you got 2,000 stocks, we don't have money to trade that. Most investors don't have money, so you have to select what you're going to do. But let me go back. The model that I've always used has been trend following, as we discussed before. It was trend following with a shorter calculation period in the 80s and 90s, and now it's a much longer period. I mentioned that as you go out to this period, you have greater risk. And so how do you try to avoid that risk? And I came up with an interesting way to deal with a portfolio that works for both futures and stocks. And I'm very pleased. I think that's made the big difference between everything I've done. I still use the longer term trends, but now what I do is I run all the futures and all the stocks through my model. And my model has, say, 5 different trends. Oh, that's a point I want to come back to discuss how I got those 5. 5 different trends and a couple of confirmations. So perhaps seven indicators to tell me that I want to be long or short. And that allows me in futures to do what I know Richard does, which is to scale into a position. All right. So as you get, some of these are short-term, some of them are long-term indicators. As you get the net of the long and short being positive, you start to scale in. All right. And I think that's what most futures traders do if you have multiple parameters. In stocks, I don't have to do that because I have so many stocks. I wait till all the parameters are in. That is, all 7 of the indicators are long, indicating that we have a very strong market. And I trade those because I believe in persistence. If a market is already doing very well, it will continue to do well for a while. All right, that's persistence, meaning it will continue to do what it's doing.
That's this autocorrelation or this serial correlation influence in the time series.
Yes, it is. yes, you start with the shortest one, and it increases. And if it gets to this point where all 7 indicators are long, something is happening in that market, like Nvidia, like Apple. We can keep saying it won't continue, but they do continue. And so that's where the money is made. And those are the markets you want to be in when they're doing well, as cocoa. If you had a smaller number of futures markets and part of that was cocoa, it would make a bigger impact on your performance. So the idea is, how do you select which of those markets you want to trade?
Perry, before we go on, just quickly, your difference also between your futures and your stocks is futures, you're both long and short, but stocks, you're only long?
Yes, thank you for bringing that up. Yes, I have tried to be short futures, but the short stocks, but the pattern doesn't work. The short stock pattern is very volatile. It goes down quickly and responds quickly. Maybe not in 2008. There's always an exception, but generally, the short side is very volatile and very short-lived. And even in 2008, where you would have made a lot of money in futures by being short the S&P, you would have given it all back subsequently. And I think what was the something alpha,
Crisis alpha.
a crisis alpha, yes. Thank you for that. In 2008, everyone was convinced that crisis alpha was the new underlying theme of the market, but it's not. It was just a one-off event. And since then, you can't really, when you put together stocks and futures, you can't really offset losses in stocks by gains in futures. It just doesn't work. The moves are not big enough to offset them. So anyway, going back to how we select stocks and how we select futures. Futures are going to be a bit more complicated than stocks. So let me just start with stocks because it's a simpler concept. What I do is I have a strategy, a trend following strategy. I mentioned it has 7 indicators. And I take that strategy and I run it through my candidate list of, say, 500 stocks. And I'm able to record the profitability of each one of those stocks. Now, I think there's some software that allows you to take a single strategy and a list of stocks and run it through. I think there are a number of trading platforms that allow you to do that. So you could do the same thing, but you need to be able to output the final result of profits.
Right. So we're talking about running our system or systems over those stocks and recording the profitability of the system, not just the return of the stock.
Yes. Yes, thank you. Yes, it's the profitability of your particular strategy. All right. I tried running this on the best returns of a stock without a strategy, and it doesn't work. You need a strategy like a trend following strategy, something that can extract the profits from the market. So you need to run your strategy through these candidates. And the good thing is almost any strategy will benefit from this approach, because I use it on futures and I use it on 2 or 3 other strategies other than trend following, and they all benefit.
It's a clever approach, Perry. One of the things that grabs me about it is that most people, when they're analysing markets, they're only thinking about the market price and how they're correlated, etc. But what you're saying is, no, it's more important the profits generated by the system, because how that system interacts with that market price determines how well it extracts opportunities from that market price. So the alpha or the edge from that. And so the important thing here is that you're looking at the trade outcomes from your system or the profits from your system as the key guiding consideration for your ranking.
Yes, but let me add to that. I have looked to see what is it that we want to rank. In other words, I've heard people say, well, we want to rank the Sharpe ratio, risk to reward. We want to rank the number of days it takes to recover from a drawdown. None of that worked. The only thing that actually works is absolute profits. And
Can we just think about touch on that, Perry? So absolute profits. Don't worry about risk-adjusted metrics or anything like that. Just look at the profits. But do you adjust those profits for the volatility of the volatility of the asset?
Yes, every stock in the candidate list has the same risk.
Yes.
So that you start with, and I need to get to allocating how much that is, but you start with saying $10,000, I'm going to trade $10,000 on each stock.
Yep.
In futures, it'll be a bit different. And I divide that by the closing price of the stock. Now, you will argue that stock prices are log normal. They're not. In fact, it's the opposite. They are much more volatile at low prices. So while dividing by the price is not a perfect solution, I remove all stocks below $10 because the volatility is extreme. And trying to do volatility parity on stocks is just too complicated. You have to keep readjusting your portfolio every time you add a stock. So the simplest way for stocks is to just take an equal investment and divide by the closing price when you enter, and eliminate any stocks that are under $10. And then you'll find if you do a scatter diagram, comes out pretty normal.
Okay. That's interesting.
I know
That's very interesting.
I know they still teach log normal in graduate school. It's completely wrong. So it's
good to hear
it's an interesting
speaking.
And you know where they got it from? They got it from the grain market. If you do it in the grain market, it is perfect. That as the price goes up, the volatility tapers off in a log normal fashion. It's absolutely ideal. But for some reason, they took the grain market and they applied it to stocks.
Okay.
And it just doesn't work. So
interesting.
Anyway, that's my observations of the market. Okay, so we were ranking the performance based on whatever strategy you're using. And then you have to decide how much of that performance you're going to use. And I'll tell you just in general, it's between 3 months and 6 months. You need it short enough so that a market that wasn't performing and starts to trend, you'll be able to pick up that trend and then use that market. Okay? And also if the market stops doing anything, well, maybe your system doesn't have a position, so you're looking for all the candidates that are ranked at the top that have a position. So, if the top performer was NVIDIA, but now it's going down and the market doesn't have a position, you you're not going to take it. So
Perry, that's just a good point. Can I just clarify that just to make sure I understand when you said that they have a position, right? So let's say you've got 500 stocks and I run them through their individual back tests and I rank them by absolute performance.
Right.
I would then knock out the ones that are don't currently have an
Right.
open position.
That's correct. You need an open
Right.
position. It doesn't do you any good to have
No.
the top 10 stocks with no positions.
Correct.
So you're not going to do too well. I mean, you
Yeah.
might do well if the market's going down,
Yeah.
but
On a
there are
relative
always
basis.
yes, there are always stocks that are bullish. Nice thing about stocks is, during 2008, you had the defense stocks. I think Raytheon was the big mover up when everything else was going down. So if you're selecting stocks, there's always something. As I said, in futures, let me point out that I'm long short everything except the index markets, which are biased to the long side, and interest rates. You may think that that's not right because recently we've had this gigantic move down in the interest rate futures markets, and it looks great. But if you go back, like I mentioned, the S&P with crisis alpha, it did great in 2008, and subsequently you lost all your short side profits. The same thing for bonds. If you look at the bond market from 1980 to 2010, it was straight up. The bond market, the Fed raises rates. Normally, it's a fairly straight process, and in the past, it's also lowered them over a longer period of time. So you're going to have a lot of periods of time where you're going to be looking for lower rates, and a very short period of time where you're going to try to profit from higher rates. So anyway, I see it much the same as the S&P. So I trade interest rates only from the long side and index markets from the long side. Everything else, long and short.
Which inevitably means, Perry, therefore, commodities, FX, currencies, and cryptocurrencies, you'd trade potentially long and short, but your interest rates and your stocks and also your indexes, equity indexes, you'd say long bias only.
Yes, that's right. That's the way I do it, and I've never been uncomfortable with that. So.
What happens, Perry, when you are only getting signals in one of those sectors or one or two of those sectors at a time?
Oh, yeah, that's a good question. In the stock market, I don't look for correlations because in order to beat the S&P, you're going to have to be in those markets that are doing the best, whether it's semis now or healthcare a couple of years ago or stay-at-home stocks, during COVID. You need to be in there. You're going to make a lot of money, but the risk will be higher. Okay?
That's a good
Futures
point,
are
because in a
different.
ranking system like you're using there, if you're choosing the strongest performers, they're, of course, all going to be positively correlated because they're the strongest performers over that period.
It's not quite that bad. There's always something else. Probably half the stocks might be in semis, and the others would be in Eli Lilly. There are always stocks that are doing okay. So you will get some diversification, but your risk will be higher.
And what about in a bear market, Perry? Like in stocks, they're much more susceptible, obviously, to all going down together. In a bear market, do you just sort of continue on as normal, or is that when your extreme stop comes in, or do you have a regime awareness that stops you from trading in a bear market?
Well, first, I think there are stocks that go long. You listen to Jim Cramer on the television, he's always sure there's a bull market somewhere. But yes, there are a couple of exceptions. I will trade a market that, like the semis or NVIDIA, that is extreme. I'll trade Tesla when it was moving up. But there is a certain point in an individual stock where I say the risk is greater than the reward. And in general, if you do a annualized volatility, I do a 20-day annualized volatility, which is the same as the options market. You can go to my book and figure out how to calculate that. But a typical stock has a trigger point at about 50%, 0.50 on annualized volatility. Once it gets above that, you want to look for a reason to get out. Okay? You don't want to get out immediately because you can benefit from this extreme move up. You don't want to just junk it immediately at 50. You want to wait for some sign that it's topped out. And then you want to bail out. But there's even a bigger picture for your whole portfolio. In other words, I keep track of my daily returns in my portfolio. And this is both for futures and stocks. And the magic number used to be 32.32. When the portfolio got over 0.32, it meant that everything was moving. It wasn't just a particular stock. There was something going on in the economy that made the whole market move.
Chaotic
you have to be
regime.
very careful. Yes, you have to be very careful. Again, it's your trigger point, and as soon as you see across the board losses, you want to get out. And in this case, I get out of my entire portfolio. And I wait for the volatility to come back down. And I monitor my returns, and the returns have to stabilize. And then I get back in. So I need a lower volatility and returns that are stabilizing. I can't tell you exactly how I do that.
Yep.
But
yes, that's the secret sauce.
So Perry,
go on, Rich.
I'll just get in my head. So we've got this ranked system. Let's say our ranking with our level of capital allows us to choose 50 of the top performers. I don't have any stop losses in this method of yours because what I'm doing is I'm waiting for the ranked item to drop out of that rank, but with loose pants because even though it might be sitting at the very lowest part of the rank, it's not immediately replaced, is it, on a day-by-day basis? How often are you ranking this, and how often do the changes occur?
Yes, you know my system better than I do. First, let me just mention that 50 is too much because when you start adding stocks like that, you're going to wind up with the S&P returns. You need to keep it down to 10 or 20 stocks if you want to try to beat the S&P. And you have to accept the risk. And the method you're mentioning, which I use, is a way of reducing the risk. So what we have is, let's just talk about 10 stocks. And we can transfer that over to futures in a minute. But let's start with stocks, which is easier. So we have 10 stocks, and we've ranked them, and we've used 30 to 60 days of performance, so they are currently active, and they have a position. So those are the stocks that I'm going to trade. And you're right. Each day, I will do this process all over again. I will re-rank, I will run the system, I will re-rank all the stocks, and I will look to see, did any of the top 10 change? And if they changed and one falls out, and you're saying there's a latitude, it has to fall out by, say, four units for for ranking positions. Otherwise, you're right. The one at the bottom will keep jumping in and out.
Yes.
So you have to give it some latitude. And sometimes you'll get a stock that falls out a couple and then comes back in the next day. So by giving it this latitude of a few ranking positions, you're not jumping in and out a lot.
I'm with you. But that's where your risk can build, isn't it? Because let's say you've got your 10 stocks ranked, you've got your latitude at your lowest ranking, but suddenly there's a change of regime. All 10 of those stocks drop in performance. So the market suddenly switched to a heavily the stocks are all heavily negatively correlated. That's where the risk can build at that with that ranking, isn't it? With no stops in place.
Yeah. It could be. That's never happened that way. But you could get, if I have 4 semi stocks in my stock portfolio, they could all go out. Because of the correlation of those, and they will be filled with something else, biotech or something. And yes, it is a risk, but this ranking process of changing these positions based on the ranking is really better than using a stop loss. One of the problems with trend following is that if you were to follow a single stock, you'd have to wait, and using a long-term trend, you would have to wait quite a way before the market turns south before you got out, and you give back a large part of the profits. In this case, it just has to fall out of the top 10. It may not even be losing money. It may be that another stock is doing better. And so it's the best case scenario. You put in a stock that's doing even better, and something that's still pretty good just drops out. So you can turn a system that normally has a holding period of 30 or 35 days in a trend following down to 16 or 17 days in this ranking method. So, which is really, so you get the advantage of using this long-term trend, and at the same time, you've reduced your risk by using this ranking method. Okay. Now let's go to futures. Futures have the problem of looking at the sectors tend to be highly correlated. The interest rate sector is correlated. Even the index market sector is reasonably correlated. And so if I do the same ranking for the number of markets that I'm following, and the best stocks are all in the interest rate sector, I will reduce the leverage that I have by 50%. All right, so I accept the fact that when I only have interest rates, my volatility is going to be very high, just because they just all move together. And if I have 2 sectors, I reduce my exposure by 25%.
I see.
And if I have 3 sectors available, I'm all in. I'm just fine. I have enough, what I consider enough diversification.
Okay.
Okay.
So you're looking at the correlation of the different asset classes, its influence on risk in the portfolio level, and you're adjusting allocations accordingly. So if you're only using a single asset class, say bonds or fixed income, highly correlated, reduce your leverage in that asset class. But as you get more and more asset classes that are collectively less correlated, you can afford to lift your leverage.
Yeah, I think that's pretty sensible.
Okay.
And these numbers of 50 and 25 were just my own idea of what they should be. That somebody could probably come up with much better, exposure limits. So,
Perry, if you're running these 500 stocks in your watch list through your models and looking at their performance, relatively speaking, why not make it 3,000 stocks and really take the cream of the crop? Is there a reason behind the selection of the 500?
Well, there was originally when I started doing this, 2005 or whenever it was. My wife, who's a futures trader, by the way, a member of the exchange.
That's trouble.
Yes, it is. So it's good and bad.
Yes.
We have a lot to talk about.
Gosh, the dinner table conversation at Perry's place. Rich, you and I, we'd love that.
Exactly. Well, at least Perry's wife's involved. Mine runs for the covers as soon as I mention trading or investing.
Indeed.
Of course, since she was a floor trader, she's always short. And I'm always usually long.
We should do a joint interview, Perry.
Yes. So on most days, we could offset each other. She makes money, I lose money.
That's the perfect hedged relationship. That's hilarious.
Anyway.
Where were we?
What were we talking
yes,
about?
I forgot the question.
So did I. What was it?
The 3,000 stocks coming down to 500. There
yes. Anyway, she suggested that the best stocks to start with were the ones that were more volatile and had low debt. And of course, I thought that made sense. They were stocks that had the most likelihood of doing well, and they had more volatility, so I could beat the S&P. And after that, and I started, and everything worked just fine. But then there are all these new markets and acquisitions and mergers and things. And so at some point, you just have to add new stocks. And when I do that, usually what I do is I run what you'd call an optimization on a particular stock to make sure they have trending qualities. And yes, I could run my efficiency ratio, but the efficiency ratio I like for a broader sense. It'll tell me that a particular stock is more mean reverting or more trending. And I use that in futures more than anything else. But just when I want a new stock, I will do a moving average over the period of time that I think makes trending sense, say 30 to 120 days. And I will look at the pattern of returns. I don't want erratic returns up and down because that says that the trends were dependent on particular moves. I like, if you try it for bonds, you'll find that virtually every moving average works for bonds. All right? And that's why in most funds, they have a larger percentage of allocation to interest rates, because that is the sector that has made the most money for them over many years. All right, so I'm looking for stocks that have pretty good reliability over a wide range, because I told you I had 7 indicators. What I do is I will pick, multiple indicators, multiple trends off those optimizations. For example, 30, 60, 90. I don't care that, 80 was the best performer. I'm really looking to get the average result of all of these tests.
Actually, Perry, while you're there talking about this, I remember it must have been 10 years ago on Better Systems Trader, you said something incredibly insightful, which was in relation to your optimization, your parameter selections. You were saying, don't, for instance, if you're using a simple moving average or whatever, don't go up in increments of, say, 100, 120, 140, 180. He said use a logarithmic approach there because it's more profound with your optimization in relation to getting stable landscapes going from, say, 100 to 200 to 400 to 800, work logarithmically there. And I remember hearing that, and that's been instrumental in my trading approach. So many, many thanks for that pearl of advice over a decade ago.
Thank you. It's for the people that don't understand logs, it's also percentage. You know, you want to increase your calculation periods during testing by a percentage in order to get the most diversification. Obviously, going from 100 to 105, is not going to give you much diversification. So you want to do it in some sort of percentage scale. But again, what I'm looking for when I do this test is I'm looking at I picked the period from 30 to 120 as where I want to be for a long-term trend. And then I want to look at what the average performance of all of those tests are. And I am happy trying to pick parameters that will give me that average percentage. All right? So I'm not going to inspect the individual performance of a particular calculation period. I'm going to say, okay, the average is good. I'm going to pick my 30, 60, 90, 30, 60, 120, whatever I'm going to pick.
So this is your defense against overfitting. By choosing that average, you're deliberately not using selection bias in your process and your optimization process, and you're going for the mid-range.
Yes. And then I can use it on a lot more markets that way. And that way I get a general strategy instead of strategies that are specifically picked for each market. And
has more universal
obviously
qualities.
Won't work in the future.
Yep.
Yeah. So I like that. So that's why I hate to call it an optimization, because it's a broad test of how this market is going to do given all these calculation periods. But you have to be happy to accept an average result. So
yeah.
Well, back tests, inevitably everyone chooses the best result. So it's a great breath of fresh air to hear someone talk about their expectation of an average result. I like it, Perry.
It's better than a negative result.
Oh, and I think in the long run, when you put these things together, it makes life much simpler. They work together well. It just seemed like the right thing to do.
One thing I thought of was filters and indicators, because we've spoken a bit about that in the past. So I don't know whether you could comment on the kinds of indicators, or do you use filters per se in this selection criteria?
No, I said I used only profits, but if we go to a different strategy, I do have two other strategies. One is,
but within the strategy itself, I mean, Perry, it's a moving average cross, but there's a certain additional filter there, say.
Not really.
Yeah. So keeping it simple.
Well, no, the filters there's a volatility filter. We talked about that.
Yes.
It has to, in the stocks, it has to satisfy all 7 criteria, and they're all trending criterias. Okay.
Right.
And in futures, it's long, short, and the exact same 7 criterias. It's
actually, that was a question process I had. So just in contrasting the stocks and the futures. So with the futures, you could end up taking a position on Monday, adding to that position on Tuesday, adding again to that position on Wednesday as you build the position based on additional models kicking in. Now, with stocks, Did I understand correctly that you're not doing it that way? You're really just waiting for, because you've got more to choose from, you're waiting for more indicators, as it were, to line up, and then you're all, all in or all out on the rotational basis.
There are two things in futures perhaps we haven't hit on quite right. Yes, it can scale into a position, as you said. But now we have this issue of target volatility. Target volatility means how much volatility you're willing to accept in your portfolio. And futures funds are vary considerably. The aggressive ones may have 16% target volatility. That means one standard deviation of their daily returns will be 16%. That's a pretty high number. The conservative ones will have a target volatility of 8%. And of course, we're leaving over 50% of the account is going to be in reserve, so we're not going to use that. So we're going to look at the volatility every day of the portfolio. And let's say I'm targeting 14%. So I'm going to want one standard deviation to be 14%. If that drops down to, let's say, 10%, I am then going to increase all the positions in the portfolio by whatever contracts I can to bring that up to 14%. And if the market goes above 14% to say 18%, I will then reduce all my positions in the portfolio back down to 14%. Some traders will use 12, some will use 8 even to do that. But it means, adding and reducing positions on a daily basis based on the portfolio. But the whole portfolio has to increase by that amount. And it does take a little time to do that. So that's volatility adjusting. And that turns out to be big. And the important part about that is when the volatility gets really high, you're going to reduce your position. So technically, you're going to be taking profits. Hopefully, they're profits. Now, I was mentioning the interesting thing is when the volatility gets very low, if you don't raise it up, if you wanted to target 14% and you're now getting 8 or 9%, you're going to have your returns go down an equal amount. So instead of whatever return you expected to get, your returns will be 40% less. So at the end of this, unless you bring your volatility back up, you're not going to come near the expected returns you plan to get when you were running your hypothetical system. So you need to bring that volatility, and that's where all the money is made, because the money is made often in low volatility markets that keep trending up slowly. And so you need to bring that your performance back up to your target volatility, and that's where you'll make your money. And on the other hand, you're going to take profits when things get very volatile to avoid that extra risk.
Perry, I'm going to let you get away with that because I know you've worked extensively with Moritz Siebert, and Moritz and I come from very similar schools in our trend-following process, and when we hear the word volatility targeting, the hairs in the back of our neck start coming up. However, I totally understand for this particular process you're talking about, I understand its rationale. It's interesting because if you compared that to, say, the classic trend follower, they apply volatility targeting effectively at the entry trade level. So what they're doing is they're saying, I will assign $500 risk to Cocoa. I will have an ATR-based initial stop, and that ATR reflects the last 25 days of volatility of that stock If it's high volatility, there'll be a low position size. If it's low volatility, there'll be a high position size, but only on the entry. But subsequent to the entry, there is no adjustment apart from the trail.
Yes. And I do exactly the same thing. That's the way I come up with my position. It's called volatility parity.
Yep.
And yes, I got that from Moritz. So, but it's absolutely correct. But now the question comes, if a particular stock within your portfolio gets very volatile, are you going to reduce the volatility of that stock? And the answer is no, because you need to capture that profit. So I do not reduce my portfolio exposure until the whole portfolio gets more volatile.
Yep.
So a particular stock can be volatile and it will not raise the portfolio to 32,
So you can still be the participant of a tail event in an individual stock and a beneficiary of that, but it's only when your entire portfolio is being affected, you're saying this regime in global sense is incredibly volatile. This is where a massive risk event can occur because I've got a diversified portfolio, which could be an extreme risk event for me if they all turn out to be adversely correlated.
And I think that is the case. When the entire market is running away, there's something going on, and you want to participate a little bit, but not completely. You at some point you have to bail out and control your risk. So I don't think we really disagree.
No, look, we're all friends.
We're all friends here. Perry, so thinking about those 500 stocks and then comparing that to futures, I'm not sure I asked, as I did last time we spoke, about the number of futures contracts that are in your watch list then, and where you start from, and then how many you end up with in your ranked approach. If you end up with 10 stocks in the stock world, in the equity world, how does that look in futures?
It's a little different, but not a lot different. I may wind up with 15 stocks, but my customer base is not interested in Asia. They're mostly U.S. and Europe. So, and there are not too many stocks in Asia that I would consider. Maybe the Kospi, the Nikkei perhaps. But anyway, I can do without them, and I'm not trading agricultural. There's not enough money in corn, and at one time I was only a soybean trader. So I feel as though I've turned my back on my original,
on your roots.
But yes. Tell me, Perry, you are a meat eater, aren't you?
Yes, of course. But anyway, I don't. There's really not enough money in the grains, and unfortunately, cocoa. In my history of cocoa, it didn't have enough volatility, enough volume, and was not a very good trader until recently. And there are times when coffee does well and other things, but trading hogs and cattle is not something you can trade on in a very large account.
So it's a similar process, Perry, where you might have a logical based, you've worked through things with pen and paper to come up with a broad universe of 50 futures markets that you have some interest in, and then you would apply these processes to bring it down to a maximum of, say, 15, and you focus on those.
Well, I can trade most interest rate markets, most equity markets, not Asia, but other than that, and most FX, and most energies. And that seems to be enough. We've done well with that. and the others just make things more complicated. So, and so those are the sectors I have. What was that? 4 sectors or 5 sectors, and as I mentioned, when I have 3 sectors, I'm all in, and before that, I'm reducing exposure.
Do you trade the futures and the equities in completely different accounts, or are they merged?
No, they're all together.
Okay, so you do get to see at a portfolio level right in front of you the combined portfolio effect of trading different systems,
Yes.
different markets, different contracts.
Yes, and all the FX is converted back to U.S. dollars every day. So at the end of the day, I get the total return of the entire portfolio, so I can measure the volatility and decide whether I have to scale up or scale down. And it's a process. The nice thing, it's all done by computers.
And you write all of your own backtesting software and whatnot in Fortran, I believe.
I did.
Been coding since 1965, you told us last time.
Yes. It goes back to aerospace, where we used to sit around, and when we had nothing to do, we would try our exponential smoothing on, which we used to use for judging the arc of missiles, and we'd use it on the stock market. And it was wonderful back in the 60s and the 70s because everything worked. It was a lot of fun. And
It's a shame you and Jim Simons didn't sit down for a bottle of wine at a lunch one day and swap notes.
I always wondered what he was doing. But even though my main programmer, I used to be in Bermuda, my main program went to work for him and retired after 9 years.
Oh, gosh. You should have taken him back that time, although they're
Yes,
obviously
I should have
very
gone with him, actually. But
privacy constrained.
But I've never actually figured out, and I've tried, and I even tried bribing my ex-programmer after he retired to find out, and he wouldn't say anything.
It's amazing the way he managed his stuff. So we chatted a lot about him in the last episode.
Yes. Well, he was obviously a good person and knew his stuff.
Yeah.
So,
Perry, just a quick question. With your efficiency ratio, the Kaufman efficiency ratio, have you ever been tempted to use that as a regime filter?
I have. I've also used it in smart execution because it tells you when you can wait and when you don't wait. The market's noisy. You can afford to wait for a better execution. But no, the only stock that seems to fall into these two different regimes is the S&P, which is mean reverting in the short term and trending in the long term. But other than that, they seem to be one or the other.
Okay.
Maybe over time they will change, and maybe I should monitor that. But that's the way I've used it.
Perry, you're using John Eller's roofing indicator.
Yes.
Can you explain how you're using that?
That's part of another strategy that I call timing, which is a very simple strategy that most people will find quite comforting. It's when you have a long-term trend and you're looking for a negative momentum. So in a long-term trend, you're looking for a market that's sold off so you can buy it at a better price.
You're looking for a retracement into trend entry, effectively.
Yes.
Yes.
And with that, I use the raw stochastic because it has the least lag. All right. Anything else, you add lag to it. But the raw stochastic can be somewhat noisy. And so I use John Eller's roofing filter, and it smooths it out
Nice.
with very little additional lag. And that's that's really quite good. And the other thing about the this buying into a low momentum or a negative momentum in an uptrend is that you need to exit the trade when the momentum goes to zero. All right? If you hold on to the trade longer, you become a trend follower. And then what's the point of doing that? Now you have a high correlation between that and the trend. If you just deal with this little piece of momentum where the momentum bottoms out and then goes back to neutral, you're capturing the piece of the trade, a piece of the trend that's not normally captured in a trend following system.
It's almost like a scalping opportunity within the trend environment. It's only looking at the enduring positive momentum. As soon as you get the slough off in the momentum, you're out.
Yes, I'd say the trends, the trades are 3 to 8 days in that range. So it's a short-term system. And it does very well in I think, during COVID when we had these terrific runs. It did fabulously well. Right now, it's still waiting for a trend. there aren't too many trends in the market.
You are looking to only trade strong trending stocks still, but you're just waiting for the pullback.
Yes.
Do you have any other strategies? Sorry, Perry, go on.
Yes, I do. I have something I call divergence, and it differs from the way most people use technical divergence. Technical divergence means that the price is going up and a momentum indicator is going down.
Like the RSI or the stochastic.
RSI, stochastic.
Yep.
Yes, or MACD, any of them.
Yep.
They're going down, and the normal interpretation is that the price will follow momentum. All right, so that the momentum is a leading indicator of that. But that, in my work, that doesn't happen to be true. It turns out that the trend is the leading indicator, so, which you can imagine. So what happens when we get this divergence of technical, with the price is going up, so the trend is going up, and momentum is going down, what we're finding is it's a pause in the trend.
A breathing point.
A breathing point. And it's a perfect opportunity when you get this to buy the trend. And like the timing system, you hold it only until the divergence disappears. So again, you're buying this short-term pause in the market, expecting the market to go back in the direction of the trend, which to me seems very logical.
Makes sense. So we've got the timing system, the divergence system, your trend following system on stocks and futures. You're pretty busy.
It's all done by computers.
Yeah. And you would trade those different strategies on futures as well as stocks?
No, I trade only trend and divergence on futures.
Yes.
I don't know why I don't trade timing. I'd have to go back and look at it.
Yeah. But obviously trading all of those together, or you do really see the value in adding those non-trend strategies to the portfolio, since they're non-correlated and they would tend to smooth your return profile.
Yes, I think Richard would agree with me. I think in another podcast, he was saying that it's much more beneficial to trade multiple strategies than multiple markets. I mean, look at the stock market. At some point, they all go together, like 2008, whatever it is. When things go south, traders liquidate everything. They liquidate their art. They liquidate their children. They liquidate whatever they can get money from.
There's a bit of an engineer in me, Perry. I like the degree of control you have in system design and how that manifests in terms of uncorrelated properties. So I like that control you have, unlike, say, the markets themselves, which are very fickle. They can be correlated one day, uncorrelated the next, or whatever.
Yes.
And that control also, in my perception, comes down to risk management. You're applying, principles of co-integration and correlation or whatever with the structural design of your systems to mitigate risk at a diversified level.
Yes. Unfortunately, it's not so easy to come up with different strategies, because my strategies have to be robust. If you look at the divergence system, I'm in a period of 5 to 15. I'm looking at divergence over a period of 5 to 15 days, and I need to have this price going up and momentum going down over a number of those periods. In other words, I'm not happy if I look at the period of 5 to 15, I have to see multiple divergences in that. Otherwise, I'm dealing with strictly an outlier. And I want multiple divergences. And I will hold the trade either until the divergence disappears or until, let's say, I have a possibility of 10 divergences. If I can get 5 of them, I'm happy. If those divergences drop down to 1 or 2, I get rid of the whole trade. All right? Because they're on their way out.
Can you give us an example, Perry, without giving away your secret sauce of 1 or 2 of those divergences and what you mean there, what you might be looking at?
Well, I mentioned before that I'm looking at the trend going up. And it's the trend versus, and it's only one trend against multiple divergences, looking at momentum over 3 to 15 days. So I want the momentum to be going down over 5 of those 10 opportunities, while the one trend, which is not going to be, it's kind of a medium-term trend, has to be going up during that period. So that's the type. So I'm trying not to catch a single case where I have one trend and the 8-day momentum is going down, while the 9-day and the 10-day are going up. So it doesn't give me much confidence in the trade. So I want to have some sort of a window of opportunity for this divergence.
Well, you are giving the secret sauce away, Perry, and thank you very much.
It's okay. The reason I can do this is I doubt that most people will actually do it. Maybe a couple here and there.
It's always the case.
But I find that you give people all these things and they do something completely different.
Exactly. Was it Ed Cicada or something who said you could... Oh, no, I think it was Richard Dennis or Bill Eckhart who said you could write down the complete rules to the total trading system and have the total confidence that no one's going to apply them.
Yes, I absolutely agree with that.
I think there's a reason behind it too, in that everyone does need to find what works for them. So you've got to work through your strategy and build your strategy up from the ground up to believe in it. So ultimately you end up with your own tweaks, and it is what it is.
Yes,
Perry,
yes.
You mentioned earlier on something you thought you might come back to that I scribbled down, so maybe I'll bring it up. You talked about working out how you got those 5 trends and 2 confirmations. You said you could come back to how you selected those in a trend following system. Do you remember what you were thinking there?
Well, I think actually we covered that because with Richard, we talked about moving them up by percentages, doing moving an optimization and getting the average result, things like that. That's all part of the same.
Yeah,
that's all part of the same problem. So
choosing a broad landscape. Yep.
Yeah, I think so. I think we've covered that.
All right, wonderful. I think we've covered a lot, and I think we've covered most of the bullet points that I had down.
Maybe this can be Trading Systems and Methods Edition 7, this podcast.
Yes, it's almost there.
Maybe.
Just one question, Perry, about futures versus stocks. When you're trading stocks, are you just using, say, the standard, like we're using no leverage, or say a 2x leverage that you might get in a Reg T account? Do you need a substantial more amount of money to trade your futures portfolio than your stocks?
Oh yes, it's pretty tricky to trade a small futures portfolio. The smallest I've able to come up with is 250,000, because first you have to put aside 50% of that to reduce the leverage and to have some fallback on that. And then you're also looking at 12 or 14% leverage, which forces you to look at your profitability and then scale down. So I'm able to trade one or two or three contracts in different things. With bonds you can trade more, but yes, the smallest I've able to reduce it is 250, and then I don't trade more than 1 million or multiples of millions. So I have a portfolio of 250, 500, and 1,000, 1 million, and with that you trade more markets, but the same 12 or 14% target volatility, but you just increase the number of markets because you're able to increase more. And that seems to be enough to make a decent amount of money.
It's interesting choice there, Perry. So you're saying with increased capital, the logical choice is diversify wider, as opposed to increasing your leverage with your existing universe. Always look for more diversification potential.
Well, with a small account, you really can't increase your exposure, is a limit. But in stocks, it's much easier because you start basically with an allocation. If you have 10 stocks, you start with $10,000 for each stock.
100,000.
And you divide, I mentioned you divide by the price, and you avoid all stocks under $10. And that's the easiest way to diversify. And because of no commissions, you could probably reduce that to $5,000 per stock. But I think there's still a cost of execution. Even if they don't say there are commissions, there's certainly a bid ask and a bunch of other things that cause problems. So anyway, it 10,000 per stock is about as much as I would allow. And I have a portfolio of 10 stocks and a portfolio of 30 stocks. But as you can imagine, as you go to 30, as Richard was saying, if you go to 100, you're going to get closer to the S&P, no matter what you do. The more stocks you add, the less you'll be able to beat the market. I had a long debate with somebody about whether you fully integrate when you're optimizing or whether you do it in blocks. I mean, if you fully integrate a lot of different indicators together, you're going to wind up with what appears to be a much better solution. But I like to go about it one block at a time. In other words, I'll test the trend and make sure that works on what I'm doing. And then I'll look at a particular indicator and I'll add that to it. And I'll want to be sure that that indicator improves the entire space of returns to make sure that I'm not optimizing something in the middle. If you're familiar with kurtosis, you're expanding the middle at the cost of deteriorating the outside. And I find that's not so good. So I want to know how each element of the strategy works with regard to the whole process. Because if something goes wrong and I have a fully integrated strategy, I'll never figure out what went wrong. But if I know how each piece contributed to the total, I will be able to figure out and correct any small part.
Helps the troubleshooting process.
It does. It also helps your understanding of what works and what doesn't work.
Well, Perry, I think we should start to sum up. And again, both Rich and myself have really appreciated all of your input over the years. Just the enormous amount of wisdom and experience, and your desire and ability to share that with the community has been very appreciated. I think it just it really helps. It helps with foundations, with building blocks. It's very logical. It shows that it's time tested and that there's a lot of experience, but also a lot of smarts that have gone into that, and just being involved in computers. Coding, literally being a rocket scientist early on, working in Gemini, the second manned spacecraft, and you've talked about working in other government classified projects and stuff. Like all of that has really come through. It's come through in your books. We've really appreciate it. We're definitely honoured and thankful that we've had this opportunity to get to know you a little better and chat with you on the show.
Oh, it's really been a pleasure chatting with both of you.
Absolutely fantastic, Perry, having you on. Very privileged. Thank you very much.
Thank you.
We should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals, or objectives. So nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.